Many wealth managers, banks, IFAs and insurers have often put strategies in place that target less than half of the liquid wealth in the nation. There is vast untapped opportunity as a result. In the UK alone, households hold more than £2 trillion in asset classes not traditionally targeted by wealth managers. One can think of the distribution of capital in the UK as a wealth pyramid. As in many countries, wealth in the UK is concentrated at the top. The top 2.4% of UK households can be classified as wealthy and collectively own 62% of the nation's liquid wealth. In contrast, the mass market, which accounts for 86% of all households, own only 10% of the liquid wealth in the country. The middle layer in the pyramid is perhaps the most relevant to wealth managers today. These are the 12% of affluent households which own 28% of the liquid wealth and are trying to build capital through high income and savings, with much of their wealth tied up in the real estate of their primary homes. There are 3.2 million households in the UK in this group, many of which not as well served by their financial services institutions as they could be. Wealth management institutions that build the capabilities to serve this middle layer in an integrated fashion will have a clear advantage in the years to come. In our experience, this requires a better segmentation model, one that takes into account both forms of wealth and age. But today's efforts to appeal to these affluent groups are often undercut by an incomplete approach to segmenting customers, one that focuses on how much income and wealth people have, as opposed to the different needs demanded by different forms of wealth. We believe that firms could do more to help customers understand their true financial position, which is often complicated by having wealth split amongst real estate, multiple employer pensions, cash and investments. At the same time that wealth managers tend to lean heavily on measures such as wealth and income to segment customers, they often pay relatively little attention to another important segmentation factor, age. Naturally, the needs of the retirees in the decumulation phase differ significantly from those of the working age wealthy. To serve an aging population better, managers need to expand into decumulation solutions, as well as craft propositions based on principal protection, risk management, and capital to income conversion. It is clear from our research that variables such as age, income, and risk appetite are critical to identifying and targeting attractive segments across the entire wealth spectrum. One approach to do so would be to harness digitization and customer data to identify distinct segments of affluent households based on wealth type and financial needs, and then refine segmentation based on additional variables such as age, income, and risk appetite. The good news is that by taking a fresh approach, wealth managers will have an opportunity to advise a largely forgotten segment of the UK demographic. Change won't be easy, but the rewards for managers who can adjust will be significant in terms of market share and assets under management.